Okay, before we move on to debt, I want to squeeze one more thing in here, which is what if the project isn't exactly the same beta as the overall company? So let's look at this example. Suppose Rice Company has a cost of capital based on CAPM of 17%. The risk-free rate is 4%, and the market risk premium is 10%. The firm's beta is 1.3. Well, so we can throw the numbers in very quickly, and we can see that risk-free rate is 4%, beta 1.3, market risk premium is 10. So we have a cost of equity capital of 17%. That's easy to do. But let's think about these projects. We have 3 different projects here that the company is looking at, and they're not the same level of risk as the company. So this is a conglomerate. It has different things going on. So you don't have one specific thing. Now, this is different than our PowerPoint company that just has PowerPoint going on. This is the overall conglomerate of Rice Enterprises here. And so Rice Enterprises has a lot of things going on. And if we do, we want to look at each one individually. So, for example, we have an automotive retailer that has a beta of 1.2. We have a computer hard drive manufacturer that has a beta of 1.3, and electrical utility, which has a beta of 0.6. So the average beta of the assets is 1.3. So the question is, when evaluating the new electrical generation investment, which cost of equity or which cost of capital should be used? Well, if it's new electrical generation investment, it's going to be aligned with the electrical generating company, and that's the beta to use because the risk of the project is related to that portion of our company. It is not an overall beta because the overall beta of the company is just a conglomerate of the other projects. Well, they're very widely different. Therefore, what we should do is use the beta that is most closely aligned with that company. So we have a different situation than we would have if all of the projects in the company were very, very similar. In this case, you can see how this plots out on capital budgeting and project risk. The project internal rate of return for the beta would be at 10%. The conglomerate overall rate of return for the beta of 1.3 for the overall conglomerate is 17%. We got that from CAPM. And of course, 2.0 would be a very high risk project, which would have an internal rate of return hurdle at 24%. So investments in more risky things than the conglomerate would have higher hurdle rates, and investments in lower risky parts of the conglomerate would have a lower hurdle rate. So you can see how the line is very important, that you put the project in the beta that is relative to that part of the company. So if it's a very risky company, I'll give you an example. Think of Apple. Apple has coming out with iPhone. We're currently on iPhone 6s, I think. And so they're coming out with iPhone 7. Is iPhone 7 a high beta project? No. It's almost guaranteed they're going to sell a gazillion iPhone 7s. So is it a high-risk project? No. They just came out with a watch. Was that high risk? Yes. Nobody knew if the watch would sell. It probably didn't sell as well as they'd hoped, but it did sell some. But they could come out with something else. The Apple car. The Apple car has a much higher beta than iPhone 7. That would not be appropriate to discount at the same rate as an iPhone 7. So when you can think about even inside a company such as Apple, the beta of the volatility of the individual project, the hurdle rate would be much higher on the profitability of a car than it would be on the next version of the iPhone. So that's one way to look at the amount of risk in an individual project's impact on whether the company should do the project or not. The more risk, the higher the reward has to be. This is a definite relationship between risk and reward. If the risk is high, such as a new self-driving car from Apple, then the return has to be really high. Because if it isn't, why would you take all that risk to do it? If the return is relatively low and very stable, such as an iPhone 7, of course you're going to do that. The discount rate on that cash flow would be very, very low. So that's the way to think about different projects. Now, we've so far only talked about the cost of equity capital. Let's turn that around and start talking about the cost and adding debt, so we have both debt and equity in the same firm.